20 years, 2.4 million. When I was thinking about what I wanted to talk about today, specifically following up on the latest survey we did, which is deep diving into my trading strategies. This is something that is very important to me, specifically in the way that I've approached trading. And I actually think that this is the exact right spot for us to begin this conversation. So if we think about the world of trading, there are a million things you could do. And most of us, when we're first starting, the idea is to make a bunch of money. Sometimes we think it might be easy. Sometimes we might think it'd be fast, maybe both. But the intention, I imagine, for just about all of us is about the same. The intention being trying to make money. And when I first started trying to project out how I was going to tackle this problem, I was still in high school. So I don't even think your frontal lobe is fully developed until you're like 25 or some shit. Main point is that I'm an idiot today, and it was amplified back then. And this is one of the things that I was able to actually get my arms around pretty well early on. And it was where my own ignorance is actually what helped me. So I was trying to figure out, like, what's a reasonable return? And this is when I first started investing. I invested for a couple months before I got into options trading. And I was figuring out, like, what is my goal? What am I even trying to do? And then things started to become more clear to me. And it's why whenever we have especially beginner-oriented conversations, I spent a lot of time talking about the idea of planning, because planning is what will ultimately make this thing work or not work. So what I'm showing you here is somebody that started, this is just a general scenario, where we start with $5,000. We save on average $1,000 a month. And we're looking over 20 years at a 20% return. And notice where this puts you. It puts you well in the multi-million range in a moderate amount of time. Like, let's not pretend 20 years is fast. It's not. And it's also longer than I would personally want to wait myself. So I'm not saying that this is the target, but what I'm trying to show you is that there is a path here. So if we think about what the market tends to return between 7 to 12%, and then trying to find some sort of method to get something to fit, then we might find ourselves closer to this than we are far. Joe says $1,000 a month and 20% return is unrealistic. I actually fully disagree with you. Like, I did this. So I'm not saying realistic in terms of like what the quote unquote average person can do. Again, like, you're literally on the outlier trading channel. And the entire premise for this entire conversation is that you have to, even if you're in this stream, you have to think about shit differently. If we try to build something that the average person can do, well, don't even bother talking about investing. The average person can't even save enough to have an emergency expense for like a $500 expense that pops up over the course of a month. Like, that's average. So the context of realistic, I think, is super relative, because I completely agree with you. The idea of like, will the average person do that? Absolutely not. But the average person also makes an insane number of very poor decisions that generally lead them to where they are. Circumstance has a role for sure, no doubt about it. But even with circumstance, there are decisions people can make to navigate a slightly different direction. But even to your point, I actually would also argue in your favor that 20% a year, that's very hard to do. And I agree, I fully agree with you there. So, and that's actually part of the scenario that I want to review today. So let's move over to the main screen and let's just kind of war game this a little bit to preamble this conversation. And for those that don't know, the conversation today, again, is just a deep dive into like my actual trading approach. So if we say 20% a year is difficult, which I fully would agree, wasn't even my target. What I wanted to do is try to find something that can outpace slightly. So maybe we'll do like 15% because that's what I used. And you'll notice that puts you at 1.3 mil. So you still cross the threshold, but this puts us a little deeper than what we might want, meaning 20 years is a hot minute. So that leads us to the other components to the equation that we can modify. And there's really only two. There's our contributions, and then there's a time span. Well, we know we don't want longer. Longer is not the direction we're trying to move this thing. So we know we want shorter. So we know if we shorten this, we're going to have less money. So then where does that put us? In this one, you need to save more. The only choice. It's the only choice. Now, you might be able to achieve a higher return than this. I've been really fortunate over my trading career, and I absolutely have. But that being said, trying to think about what's normal and abnormal is important here. Because when we think about the idea of achieving a higher return, a really big part of that is luck. And I'm the first one to admit it. Now, do I think my return is luck overall? Absolutely not. I know that I work super hard for it and I can quantify what I do. However, there is something to be said and to acknowledge about the alignment, just the happenstance of where a trader is at in their trading career. What does the market happen to do during that time frame? And how well is that trader able to capitalize it, good or bad? So when I'm talking about luck, I don't mean luck in terms of making money. That's not luck at all. And I know that's not luck. I'm super confident in saying that that is skill. And I know it's skill because of being able to achieve positive returns when the market's in down and stuff like that. That's skill, confident. But what I'm talking about is this range here. The difference, if we plot this for an example, between a 15% return over this time frame and a 28% return. Watch what happens to this number. Skyrockets. It goes parabolic. So do I think that this is realistic? Do I even think that, knowing what I know now, that I'm going to maintain this going forward? No, I don't think so. I certainly don't think so. The only reason why my compound annual growth rate is that high is because my last 2 trading years were so unbelievably anomalous as far as the rest of the sample is it skewed everything to the upside. Realistically, my compound annual growth rate tends to be the low 20s, and I fully expect my compound annual growth rate here to trickle back down into that range. So what am I highlighting here, and what does this have to do with my strategies? What I'm highlighting is that the way that you start this game is really important, and it's going to inform what you try to do from there. Because, as I just told you, this was not my starting goal. This was not my starting goal. My starting goal was something that what I consider to be slightly better than this, which was 15%. So in the pursuit of 15% over the last 18 years, I find myself at this number right now, but that's not what I was targeting. So there was a deviation along the path, and I'll explain why a little bit later. This part is super important because when we talk about my approach to trading was built trying to achieve this. how do I get to this number? And the way that I thought about it was like this. If I build you a time series, and let's say, I'll do it down here so there's more space. Let's say that this is year 20 and this is year 0. I keep forgetting to update the space on the driver for this thing so I can use the bottom of my screen. This is year 0. So the way that this works, in my opinion, is in the beginning few years, you're going to have to bounce around. It's going to take a while to figure out what you're trying to do. So in these beginning years, I think it's way more impactful to focus on building your process and getting this number up, whatever you have to do. For me, it was a mix of things. I've always worked a bunch of random side stuff to find more ways to make money. You guys have heard this stuff a million times. It's stuff like in college, I used to buy and sell motorcycles. I used to shovel for people. It's like all that kind of bullshit. I just found ways to make money. Then I made a mistake in that my first 2 years were negative. First 2 trading years, both of them were single digit negative, so it wasn't that bad. But nonetheless, my first 2 years were negative. So that actually moved me backwards, right? Lost money. I lost money in a point of time where I was really like, I gained very little from that experience. That's the frustrating part, is when people say like, oh, you got to use live money. And it's like, there's nothing like, sure, use it. There's nothing that replaced live money. But what I can tell you is that the shit that I learned in the first couple years could have been done without live money. Without a doubt. Did not need to be the case. I was impatient as fuck. And a big source of that impatience, I realize, is also what has led to me being able to do this. That impatience has led to, the reason why I'm impatient is not because I want what I want right now. It's because the starting point is uncomfortable enough that it is a significant motivating factor to try to find ways to make that not the case. So my entire focus was on building something that was repeatable, that I could consistently land around this number. That was my entire idea. It's very different than what a lot of people pursue. The reason why this matters so much is because if I were to pursue top line performance, meaning get the best possible return I could, I genuinely would take a different approach. So as I talk to you about my trading approach, it's very important for you to know that context, because the stuff that we're going to be talking about is stuff that's optimized for robustness. It's not stuff that's optimized to get the best possible return right now. And it's because I viewed it as a like genuine no fail scenario. And you guys all know the context behind that. Not going to waste your time, but that is absolutely why that was my focus, is because for me, it was a no fail proposition. It wasn't something that I could just risk the money and, you know, if I lost it, I could just make it back. Sure. It has cascading impacts that I cared more about. So that consistency is an ultimate driver of what you're about to learn, which is how I generally trade. Okay, cool. So let me trash all this, and I want to just go through a broad overview. And I'm not going to spend a ton of time deep diving each individual piece, because this is a beginner series and I want you to focus more on the core concepts that we're going to discuss. And then I'm already working on an offshoot of this to go a little bit deeper. I'll probably do that on like the Thursday skill development streams so that we can like hone in on individual pieces. But that stuff doesn't matter as much as the main stuff that we're about to review, which is this eyesore of a slide. So the left-hand side, you could see how I trade. Not really going to spend a ton of time on that up front. I want to spend more time on the right-hand side, and it's specifically number 4 and number 5. So when we think about building a trading approach, You all at this point hopefully are familiar with what I refer to as the outlier strategy process and the outlier trade process. And it's just a framework for thinking. But the strategy process begins with a profit mechanism. It does not begin with a strategy. It does not begin with a structure. It begins with understanding profit mechanisms. And there's a lot of ways we can do that. And I will show you one of them right now together. So I'm going to move this out of the way for just a few moments. And let's take a look at Palantir. Palantir's fine. It's already up. Okay. So if we take a look at Palantir, and I just zoom out, and I'm going to zoom this in so that we can cycle through it. But I want you to focus a little bit on the earnings release and then the move following the earnings release until the next earnings. So in this case, it's too early to tell. We can't tell. So let's scroll back, and we have an earnings release here. And then leading into the following earnings release here, this is up, right? We can see that. So that's one. Next, let's scroll back. Let's take a look at this earnings. Let's take a look at this earnings. This is up over the course of that earnings. That's 2 for 2. Next, let's take a look at this one. This earnings to this earnings, 3 for 3. I'm literally just looking at price direction. Next, we'll scroll back. Look at this earnings. This is after the close here. So then this is where it would have opened post earnings here into the following earnings, which this one is after the close. So it would have closed here. So that's still up 4 for 4. Next, take a look at this one. After the market here, 5 for 5. And we'll do one more. Take a look at, this is before the market. I knew that one of these was squirrely. So this is prior to earnings. This is on earnings. We'll just use on earnings. And we'll run that across, and it opened here and closed here. So I would call that 5 for 6. Okay. That's one ticker. What did I just show you? I just showed you a profit mechanism. That profit mechanism is very well known. It's super well researched. It's called post-earnings announcement drift. There are certain criteria that go into narrowing it down and making it stronger in some instances versus others. But this is something that becomes relatively predictable. Not purely predictable, relatively predictable. What I'm trying to explain to you here is the importance of not worrying about if I should use MACD or RSI. Not worrying about if I should sell my option at 45 days versus 40 days. Not if it should be at a 35 delta versus a 30 delta. All of that stuff is secondary. Not saying it doesn't matter, but it's secondary. And I always use the example of a high class problem. If I sell a 30 delta and I say to myself, shit, I could have made more money with the 35 delta. Cry me a river about it with the money you just made, right? High class problem. Get over it. But what I can tell you is that it doesn't matter if I sell a 30 delta put or a 35 delta put and the underlying goes down, I lose. And then it's a low class problem. It's a function of how much do I lose. The point that I'm making sure is abundantly clear is that your sole focus when building strategies has got to be on profit mechanisms. It's the only thing that matters. After profit mechanisms, then you can get into the nuance. Joe says, at the end of the day, it's always about price change. Very close. I actually fully agree with part of that for sure. And it's a really important point. So I'm glad you mentioned that, Joe. It's very, very close. Now, for those that are listening, why do I say it's very close instead of saying I fully agree with that or that's completely correct? Because there's an important caveat here, especially for options traders. Anybody guess what that is? Why do I say mostly? Mostly correct. Volatility. There you go. Reese has it. Because if we think about profit mechanisms, they all fall under just a few umbrellas. There's not that many of them. There's stuff that deals with price, direction. There's stuff that deals with volatility. And then you can argue that there are some structural profit mechanisms that very often are subsets of these. Not always, but very often. I'm not going to go into things like pricing discrepancies and stuff like that, but they do exist sometimes. So the reason why Joe is very close but not fully on target is because when we think about profit mechanisms, there's two buckets. And for example, if I'm trading vol and I buy a straddle, in the process of buying the straddle, and let's say that I gamma hedge, I guess I'll call it gamma scalp because we're long, I want to cover that cost. And then I'm going to gamma scalp and delta hedge, which is same essentially in this context. What I'm doing is I'm actually muting my susceptibility to this. I'm isolating a different profit mechanism, not price, but volatility. So those are the two starting points that you have. That's the beautiful part about this. And this is the beautiful part, especially for those that are on the stream right now, is if you ask most traders this kind of question, they will have no idea how to even start tackling this sort of thing. And it's because most people don't think like this. It's not because I'm super unique. It's just because I've looked at this shit long enough that I've found ways to categorize stuff in my mind. That structure adds so much efficiency to what I'm doing. And this is why, again, looking back at what I've been able to return, why I've been able to return those kind of metrics is because while tons and tons of people are looking at and trying to solve the exact wrong questions, not due to being stupid, but due to their own ignorance about the topic and not getting structured enough. So when we're thinking about profit mechanisms, this is effectively how I break it down. There's price direction, there's volatility, and then again, there are some other things that would be good for another stream. They're not really relevant right now, but there's maybe three others, plus three plus in this bucket down here. So if we then click into these, we can start finding some really good ideas. Ehaj says price can't change without volume in a direction. So what categorized each differently? That's not volume, that's volatility. So it's a great question. I'm glad that you asked it because people who are used to trading stock will see vol and they'll see volume. Options traders, when we see vol, we see volatility. So this is volatility, not volume. Good question though. So then if we think within price direction, again, there are different things that I can even see just by eyeballing a chart. This isn't trying to like overfit and look for patterns. This is literally just eyeballing shit. One of those things I literally just showed you for price direction. I just showed you post earnings announcement drift, in this case to the upside. That's a price directional trend that we can see. We can quantify it. We can literally measure what the average move is for a basket of stocks that have certain criteria and see what the average move is post earnings. One of the easiest places to start. Then we can think of other kinds of ideas that go into price direction. So another one, you guys will know this name, good old APP. So I think this is about right. Yeah, so let's zoom this in. One of the cool things Thinkorswim did is they fixed this, so now we can actually get like pretty specific and granular. Okay, this is what I want. I'm just adding a couple more data points to the sample. We need to go back a little bit longer. One sec. Do a 3-year. Do the same thing. Okay. So I want you to look at something. So this is a trade that I took last year, and a bunch of the Discord members and people that have been attending the streams, you guys will know about this one because I spent a while talking about it. This is one of the wildest trades that I've caught. And I remember distinctly, this was my entry, September 11th. So notice how earnings is back here, and I did not play the post earnings move. And it was for a couple reasons, but one of them is it didn't actually fit the criteria that I use. So that doesn't mean that it can't exhibit drift. It doesn't mean that it can't go up. It just means it doesn't fit the criteria for that specific strategy. So then price goes sideways. This is already on my watch list for a series of reasons that has to do with the volatility, price direction, all that kind of stuff. And then we roll sideways, and then we come into this day. So this day has massive volume. There was a strong catalyst in terms of news that sent price rising. So leading into this no position, this fits what I call a breakout. Breakout has certain conditions and criteria that I've set for my version of a breakout, and this fit most of them. So I enter a long trade here. It was with calls, doesn't matter for the sake of the conversation. And then we start fast forwarding time. And I just want you to look at this move from entry points. So not the whole day. I didn't get in at the bottom. Entry point until it starts consolidating sideways. This is a 57% move, and this is over a month. So a breakout has very specific criteria, and a breakout can turn into other kinds of trades, momentum, namely exhibiting some level of drift. And that's mostly what this did, right? The breakout occurred, and then it had a couple follow through days. In my world, the breakout stops in this time frame. And then if it continues, then it starts leaning more into momentum. So now, notice this here. And then for those that were on the stream yesterday, there was a stock we looked at. It was T. Good reminder, gang. Thank you. T. It was somebody that one of the members was looking at. What do you notice about T? Well, let's take a look at this earnings move. Let's just call this a breakout, and let's measure this breakout until it started consolidating sideways. This is over 30 days, and this moved 14.5%. Not a bad move. But what do you notice the difference here? This is 10 extra days and 35% less return. What I'm showing you is that the criteria in my approach for a breakout is specific. You could still call this a breakout. You could call it post earnings announcement drift. It doesn't matter. You can call it a fucking potato. Call shit whatever you feel like. The main point is that this doesn't fit the general criteria that I use. So even though this might have fit for that reason, this wouldn't have been a candidate in my world for a breakout play. Okay. So at this point, you should have a pretty good idea of at least this concept of what a profit mechanism actually is. And I've given you a couple examples, and you should have at least a loose idea on how to find them. Now, one of the reasons why it's so easy for me to talk about these, because I fucking know them, right? So I am fully aware that if you don't know and we stop there, then the question is like, well, fuck, how do I find something else? It's a great question, and we should take a look at it. One of the first things that I would do personally, if I wanted to try and solve for this, is I would start by flipping through big amounts of charts. It's exactly what I did. I used to look at thousands of them. I'm not looking at the charts to try to identify candlestick patterns. I don't really care. When I'm looking at charts, I'm looking at price and volume, because we know ultimately that's what moves price. And if we're exploring some sort of price-driven strategy, we need to understand price and volume. So what I do is I say, oh, that's kind of interesting. If I look at T, some shit happened on 25 November of last year. Volume went up massively. Volume was at 64.7 million, whereas the 5-day average was 33, and the 20-day average was also 33. So it effectively doubled. Why? And then what I would do is I would literally go back and I would see what happened. Why did it do that? What I'm saying is you start to get an understanding of the kinds of pieces of information that move stocks and the kinds of information that might not move stocks, or the kind of information that sometimes you see it move stocks, sometimes you see it doesn't move the stock. The important part here is that we're not actually looking for some sort of magical chart pattern. We're looking to build a really important contextual understanding about how things move. Because again, we haven't even talked about strategies yet. We're a half hour in. That's on purpose. It's because they don't matter that much. And I'll show you why. If we go into T, and I actually want you to answer in the chat. If you were to build an option strategy to trade this move right here, you don't have to be super detailed, but what trade would you put on? What trade would you place in order to play this 12.6% move, knowing what happens? What do you guys think? Reese says ratio call diagonal. Any other guesses? What else would you guys do? Let's take a look. So this move started on 27 Jan and it goes to 7 March. Joe says long calls. Ricky says out of the money calls. Shrey says +1 Reese without short calls. Okay. Now, there's an important element here for us. What expiration would you guys pick? Pick your expiration. So for Reese, pick an expiration. Joe, pick an expiration. Ricky, Shrey, all of you guys pick an expiration. And while you're picking an expiration, give me deltas. All right. So let's grab our workbook. Get rid of all this shit. And let's learn about some profit mechanism. So this is all going to be on 27 Jan. I don't remember how many of you came up with something, but it was a few. Stock price right now, 2024. I'm just going to default to a 1 lot for everybody because that doesn't matter. Okay, so let's see the expirations. Triforce says 60-day at the money calls. All right. So 60 DTE, that puts us closest to 60 DTE is 21 March. And at the money, we'll find closest to 50 delta. I'm going to slide this out of the way so I can actually take a peek real fast. That puts us up to 24s. So 24s, and that's 55 delta. Our premium here, I'm going to just take it at the offer. So 0.75. And then, oh, this is kind of annoying. All the math is broken. That's the worst. Equals, give me 1 sec. We'll figure it out. So we have our one lot here, 75 cents. All right, what else did we get? Lauren says 1 to 2 months out, 40 delta. Okay, so we'll look for 30 days. Closest to 30 days is this 28 Feb. So let's grab the 28 Feb. I'm gonna move this over a little bit more. And you said a 40 delta, which we can absolutely accommodate. Let's find us a 40 delta. It's right here, the 24.5. So this would be 28 Feb. That'll put us at the 24.5s. Delta here is 0.39. And premium here will be 0.33. Okay. Next. James says 15 days, 15 delta. Okay, James is going to have a problem, but that's okay. The move we're looking at is over this duration, but that's okay. It'll still be a good example. So closest to 15 days is 14 Feb. And you said 15 delta, 25. Which gives us an 18 delta. That's the closest. And then we get those for a dime. Okay. And we'll do one more. We'll do two more. H says 60 days out, 70 delta long. Let's do this one. I like this one because it's an actual diagonal. So this one will also be 21 March. And you say 70 delta long. Okay. That puts us at this one, 23. That puts us at 0.77. Premium for those, 148. Again, I'm just using the offer for all of them. And then here we're going to be short. And then all of these will have a C next to it. Okay. And then you said 30 days out. That puts us at the 28 Feb. And then you said 15 delta. That puts us here at the 25.5. And then you're going to collect 7 cents on that. Oops, my bad. The 14 delta. And you're going to collect 7 cents. Okay. So I'm going to break this one out so that it's its own thing. And then there was one more from Shrey that I saw. 20 June 25. 20 June 25. $40 to $35 delta. That's funny. None of those are available. So I'm going to go with the 25s for you. 25 call. Delta is a 0.43. It's the closest. And we're getting those for 89 cents. Sick. Okay. So now let's fast forward time. And as we discussed, we're going to 7 March. So we're going to have to take a stop on the way for a couple of these that are before that. We need to stop on the 14th of Feb. That's the first stop. The 14th of Feb, we have the 25 calls at an 18 delta, and we got those for a dime. So let's go to 14 Feb expiry. Right now, the stock price is loading. So that puts us at 25.86. So the closing price we're going to get for the 14 Feb 25 calls is 85 cents. Cool. I'm just updating the signs on these. Heck. Okay. And then we have to stop on 28 Feb for our next choice. What I'm going to do at the end of this is show you what the P&L looks like for these positions. And we have 2 that we're going to check out on 28 Feb. We have the 24.5 call, 39 delta. We got those for 33 cents. So now the stock is at 27.17. And for the 24.5s, those are trading for $2.64. So that's our first one. And then our second one is just closing out the short call segment of this ratio call diagonal. So the 25.5s, those are trading for $1.64. Okay. I'm not going to bother doing like rolling and all that shit. I'm just going to finish out the example. So next stop, we need to go to 21 March. We only have 2 stops left on our trip together. Well, really only 7 March. That's a lie. We only have 1 stop because we're just going to flatten everything here. So now we're at 7 March. And it's at 27.1. And we need to close some trades. So we need to close our 21 March 24s. We're going to close those for 310. We need to close our 25 calls that are in 20 June. Those are 279. And we need to close our 21 March 23s. Those are 410. Okay. So now let's see how we did. Is this accurate? It looks close enough. These need to be times 100. Nope, that ain't right. That's for sure. Oh no, I already did the math correctly. Great. Good. Okay. So let's see Let's see how we did. Don't worry about the signs. The signs don't really matter right now. First things first, let's just eyeball which of these strategies gave us the best return in terms of P&L. So again, for this bottom strategy, we would have to net these. And then we need to divide this by our cost. Again, don't worry about the percent returns here. So this trade boils down to this one. So what do you guys notice? Well, I notice a few things. I noticed the 28 Feb 24.5, the 40 delta gave us $231. I noticed that the 21 March 24 call, the 55 delta, gave us $235. I noticed that the 14 Feb 25 call, 18 delta, gave us $75. So there's a couple really important points here that go back into the idea of figuring out how to build a strategy around a profit mechanism. Is that if we take a look at this scenario and we see how all these trades played out, we can see that there are some that performed very well compared to the others. We can see a middle of the pack, and then we can see the bottom of the pack. Great. Now, if we take this same exercise, we're not going to go through it, but if we take that same concept of an exercise, and then we apply it to this move in APP, and we apply it from the move from here to here, 442%. We would probably change some things about the trades we put on, yes? I assume that will be unanimous. What I'm showing you is that rather than worrying so much about what option strategy you want to try to build, if you spend more time analyzing the profit mechanism, you literally start to answer the question for yourself. So in this scenario, we probably know that we would want to put on something that compounds better. We know that not using flat one lot across the entire scenario, we know that there are certain strategies, certain option structures that will perform way better than the others. Because again, if we go back to this scenario, although these two are created relatively equal in terms of P&L, take a look at the return on capital. They're not the same return on capital. So if I were to scale these to not be one lots, but to actually be the same size, this one actually would have two. And this one would smash this one, right? So the point that I'm making here is that I normalized all of these based on a one lot, but really what matters in this context is actually this number, the return on invested capital. And we can see that this one did really well. We can see that this one did insanely well. Again, if we were to scale this one to be the same as the others in terms of total size, then this one beats everything. And it's because this was a lower delta. The lower delta did super, super well. And it's because we knew in that scenario, we cherry picked that the thing would move a lot. But what we're looking at here are a mix of people, in my opinion, that are just defaulting to an approach because it's the default approach. We're not taking the time to think about the scenario and to fit something to that scenario. Now, all that being said, This is a hypothetical. We're looking back in time. But the point is, everybody should be able to build an extremely well-performing strategy if we know what happens. Then the game is trying to figure out, what are we able to accurately predict reliably to some degree of consistency, and then to build something that generally allows you to capture that. So I'm in no way saying that this is the best choice. It's most certainly not. But what I'm showing you is an important skill of taking the time to, one, understand profit mechanisms, and then two, taking the time to deeply learn options in how they behave. Because if you do those two things in this scenario, you would know that there are even better versions than everything that's here. There are strategies, simple strategies, that would make more money than all of these. None of these are optimal. And that's okay. It's not about picking quote unquote optimal. It's about this understanding of how things behave. So the point to take away from that entire segment is that based on our idea, what we build will look super different. It will look very, very different depending on what our idea is. So now, to go back to this quickly, and then we'll get into some Q&A because I got a couple questions ahead of time that are pretty good. I want you to just take a second to take a look at what's on here. And then I want to talk to you about the way that I mentally implement all of these. Because it's not about what the strategy is itself, or the structure in this case. It's about what the profit mechanism is, and then finding something that fits that profit mechanism. Give me one sec. Oh boy. So, when I look at what my goal was, and if you'll recall, my goal is consistency. Okay, so let's deconstruct this. If I'm trying to make a consistent 15%, can I buy an index? Well, it depends on the time frame for this. Because if we take a look, and I forgot we could just do it in here. If we take a look over the last 10 years in SPY, this is a monthly chart, by the way. You'll notice that there are very clear periods where things roll over. That's okay. I don't necessarily mind that. But if I do this for a long enough period of time, well, then this can become pretty powerful if I'm able to get 15% each year. So that's an aspirational goal. Not what happened at all. I didn't even crack this for several years. So that tells me that if I want to do something that's like really basic, it's not going to work. Meaning just buy and hold an index. It's not going to work because the market unequivocally, we know it has down years. If we take a look at 22 here into 23. This was a quasi bear market, just shy. Bear market. It didn't end the year in a bear market. It ended the year like down like 19%. So that gives us important feedback. So if we go back, we now know definitively that the answer to that is no. But if I go back to the same example that I just gave you guys, looking at the last 10 years, what do I notice about most of these 10 years? Notice most of them are up. Most of them are positive. So for those that understand the way that I build out my portfolio, this should completely logically make sense and hopefully close the loop. Most of the time up. So what does that mean? This is the birth of a core allocation. This is the birth of a covered strangle in an index ETF. Because most of the time, this will get me damn close. Most of the time. Now, for those that have been following along with the recent covered strangle example that I've been working with you guys, you will notice that there's a way to amplify this. Levered ETFs, coupled with trend following. This is a way to, in a leveraged manner, benefit from as much of this as we can, but decrease our downside participation. So this is one of the easiest ways to at least conceptually build something that can outperform the market relatively consistently. And again, it's because the market most of the time goes up. And then as long as when things are going down, you're not asleep at the wheel and you have a good approach, well, now you can easily rotate out. But there's an important difference here. If I'm trading the covered strangle, the stock's going up and then things start going down. And let's say that I get cut out here. Okay, cool. Let's say at this point on the year, I'm up 8%, wherever the year started. Let's say the year started like there or something. Well, this is not this. This means that I need other tools in the toolkit to be able to use in order to make money when this is not doing what I need it to do. Most of the time, this will do the job. But there will be periods where this doesn't do the job. And I can't just sit and wait out those periods. Otherwise, this goal doesn't happen. So then I need a speculative toolkit. And this is where I implement strategies that allow me to create either inversely correlated returns, non-correlated returns, and to have other things to do when this isn't working. But if that's working and doing what I need it to do, then there's no reason to not lean into that with most of the accounts. What I do. In the speculative allocation, you guys already know a lot of the things that exist in here. So in the speculative allocation, that's trading things like pivots, flow, breakouts, breakdowns, maybe some sort of momentum depending on the time frame. I would call it that for sure. It's pretty much all of the volatility suite that I trade. But all of these things are literally designed to give me something that I can trade in effectively every single market condition without exception. And this is my broad approach to trading. This is what I do. This is when the market is having a year like it is now. This is a great example. So far, what we've seen this year is a great example. If we plot year to date, what do you guys notice? that shit is flat. That is super flat. And for all of the guys that are on the stream, which will be most of us, you guys know without a doubt that firm, plump, round is better. But in this case, just get rid of some of the round. Got to be more of like a diagonal. So if I were to take this idea of 15% consistent, and you guys already know how I do this. Begin with the end in mind. The Marine Corps version of this is just reverse plan. So what I need to do is I need to figure out, I need to break this 15% out. I can't just wait until the end of the year and be like, am I at 15%? I'm not. Fuck, I missed it. That's not going to work. So what I do is I build milestones monthly, quarterly. And what I do is if I'm supposed to make 15% over the course of the year, I know, again, that if I plot a time series, January to December, I know that it's not going to be linear like this. Not how markets work. But what I need to make sure is the case is that if I break this out over quarters, that even if over Q1 I'm up and then I go back down and then here, like this is still success. Because even though this might be plus 2% over that first quarter, so behind pace, but still in the correct direction. And then next month we try to bump that up and so on. So that's why my account is up so much so far this year, is because even as the market is doing this, I'm not just leaning in with the core allocation and then just kind of like waiting and seeing how it shakes out. It doesn't work like that. I use the core allocation over this time frame. The core allocation still fortunately makes money, and it has everything to do with the beautiful component of options. Being able to sell premium as things are rotating sideways in an index ETF is still good. However, in some sort of levered ETF, this is also a slow death if it does this for too long. So can't just do that forever. That's when you guys saw me rotate into short puts, and I've been in short puts mostly since. And it's simply because the market has been oscillating sideways. This is not a good period to be into a bunch of long levered ETFs. Would it be the worst thing on earth? Something that you can't navigate longer term? No, it's okay as long as you have a long enough time frame, but it's not what I do. Okay. So I want to summarize with a couple things, and then we can get into Q&A with whatever you would like to talk about. The most important stuff that you could possibly take away from what we talked about today is not the individual strategies that I use anywhere. That's really not what matters. What matters is the process we spent the beginning half of the stream focusing on, which is your best possible bet to build something that works for you is to invest the time in understanding profit mechanisms. And then it's to invest the time into deeply understanding options, how they work. And if you do both of those, then you will arrive at many of the same conclusions that I have here. There's nothing novel in what I do whatsoever. There's literally nothing novel in what I do. And it's because it's based on pure market fundamentals. That's literally it. That's literally it. So when I'm trading stuff like breakouts, breakdowns versus pivots versus flow, there are different ways I set up those trades based on my forward expectations, based on how I know those things behave. And again, I have another slide that I started to build that will go into detail on those with some recent examples for all of them on the Thursday stream. However, the main thing to pay attention to here is that for direction, if I'm trying to trade something that's bearish, it doesn't matter if I sell calls or buy puts. If the thing goes down, they both make money. It's now a high-class problem of which one makes more money based on how this thing happened to go down. What is unacceptable is if I put on long puts expecting something to go down or short calls expecting something to go down, and then it goes up, I'm wrong. I'm wrong in either case. I've lost money in either case. Again, then it's a low-class problem of how much did I lose. What's unacceptable is that if I'm not able to find an approach to differentiate enough to create positive expected return, because it's completely unrealistic to, and I'll give you a recent example. We talked about this on this past Thursday stream because I think it's super important to talk about losing trades. And speaking of bearish plays, I had, not that, I had this. I had SATS and I had short calls. Now, this is a deeper part of the position. I had been trading this to the downside for some time. My short calls were like way up here at like the 24 handle or something. And I took the trade off at a small loss in here. I forgot which day specifically, but in here. And the reason is because it found a bite, rallied, fell back down, found the same bite on like the same general volume node, rallied. And even though that it would have been better off today, it doesn't ultimately matter to me because while I was in this trade, it wasn't doing what I thought it was going to do. And that's okay. That will happen so frequently. Take the trade down at a small loss, move on. The idea here is still completely valid. But what I care about is how does it behave in this region? And for the strategy that I had on, and for the idea that I built this trade around, this wasn't doing that. Would the short call still be fine? Yeah, of course. Got plenty of room. But it didn't align with the idea that I had. So it's really, really important to define the idea so then it becomes super easy to manage a trade. Because all of the questions of like, should I do something? They go away because it's literally a function of, is this thing doing what I thought it should do? Yes or no? No, it is time to get out. Regardless of what the P&L is, it doesn't matter. It's not doing what it was expected to do. And then if you find yourself in too many of those cases where shit continues to do stuff that you're not expecting it to do, that tells you that you don't understand the profit mechanism well enough. It literally is giving you all of the feedback you could possibly need to build a better strategy if you listen to it. All right. That's enough of Eric's soapbox. As you guys can tell though, like especially this topic, I'm deeply passionate about because this is ultimately what trading comes down to. And notice how most of the stream today wasn't about like my specific strategies because it doesn't ultimately matter. That's not what matters here. What matters here is the stuff we spent the bulk of the stream talking about. Now, that being said, I'm happy to talk about individual strategies. If there's ones you guys want to talk about, happy to. Let's do that. But I want to make sure that we're not wasting time me telling you how I trade a ratio call diagonal because that doesn't matter for somebody else. It's not going to translate. What's going to translate is the research process that I shared with you. Now, that being said, there were a couple questions that I got from the Discord before, and then I'm happy to open it up to anything else. But one of them was from the boy Dan, who says, curious to know more about when you look at fundamentals and which ones, and when you don't care. It's a great question. So the way to think about fundamental and technical analysis is this. If we go to strategy process, it matters here. This is when I start looking at fundamentals. So effectively, when I'm looking at profit mechanisms, I'm just looking at something that moves in some way that I think I can monetize. Then I need to understand it deeply. And that's where I do all the research and understanding, going back to post earnings announcement drift. That's fundamentals. And understanding what criteria is important for something to, on average, exhibit post earnings announcement drift is literally quantifiable. You can do the research. You can find out just like I did. It's not that difficult. All I do is take a look at a few thousand stocks over the last 10 years, and I analyze the conditions around their earnings releases and what the follow-on price performance, not only over the next quarter, I actually do like the next day, 3 days, 5 days, 10 days, 20 days, 60 days, that kind of thing, and measure and see what it looks like. So the way that I use fundamentals is twofold. The first way that I use fundamentals is general understanding of things, context. So there are a lot of instances where I will have fundamental knowledge, but it's not necessarily a big part of the trade decision. It's just something that I'm generally keeping an eye out for. That's one scenario. Then the next scenario is if I'm trading something that fundamentals matter for my idea. Here's the way to think about that. And then we'll get into what fundamentals, because it does matter and it actually changes based on time frame. Fun fact. So if I was trading, let's say that I wanted to trade SATS, but let's say I wanted to trade their earnings release itself. I was going to trade volatility for their earnings release. Do I care about the fundamentals? No, I don't. It doesn't matter to me. It makes no difference. I care about vol in that instance way more than anything. So I might look at the fundamentals for context, but I don't really care. Let's take a look at another scenario. You guys know that I have a position on in Palantir. This is a much longer term idea. The position I have on in Palantir is like all the way out into 2027. So clearly a completely different expectation here. So fundamentals do matter. And fun fact, you can deconstruct what fundamentals matter over what time frames. And there's a really easy way to think about this. So if we take a look at Palantir, and we take a look at their financials, there's a couple things that matter to me pretty much more than anything. Early on, things like the multiple actually do matter, but not that much. Things that matter a lot, if you think about, again, you can always do yourself a favor if you go back to the basics. What does a company do? They sell something. This is what a company does. They can sell a service, they can sell a product, but they sell something. How is that working? How is that going? So the very first series of metrics that matter the absolute most to me are sales. That's what the company is meant to do, sell. It's got to sell something. So that's the first thing I care most about. Then after that, it starts getting more nuanced based on the holding duration and what I think matters the most. But revenue, how much is it able to keep? I care about things like operating efficiency metrics. How well does it manage the money that they have? I care about things like debt. How much debt do they maintain? Debt matters a lot because it can absolutely tear a company down. If they misuse debt, it's not good. So what I can do is get a sense and literally take a closer look at how things are going in terms of how are sales going, How much of that are we able to keep? How well are we growing assets compared to our liabilities? I also care about solvency. So that's things like quick ratio, that matters. Those kinds of debt metrics. So the period where that kind of stuff matters the most for me is actually when it's a longer term idea. Shorter term ideas, I don't really care. Post earnings announcement drift is anomalous in that it's a shorter term idea that I still do care, but it's because it's literally the premise of the profit mechanism. So fundamentals matter. It's ultimately what moves a company. Even things that I'm trading loosely, I'll generally have an idea, but there's an equal number of instances where I have no idea. I used this example yesterday. This is completely true. There are times where I'll trade things that I literally don't even know what the company does. I have absolutely no idea because some of the things I'm trading, it doesn't matter. If I'm trading volatility in something, I don't really care. I just care about what vol is priced at, what I think might be an opportunity for where vol might be better placed at. Not saying that it's too expensive or too cheap, because who am I to say that? And then that can become an idea. But that doesn't matter so much. It's not really based on fundamentals at all. So that is for my boy Dan. I don't know if Dan is in the stream, but I'll let him know. Talked about this at like hour 10. And then another one was from Elizabeth, which is how you practically incorporate Greeks into the strategies. This is one of like the greatest possible questions. And you guys actually got an example of it here. The way that I incorporate the Greeks is by, once I understand how the profit mechanism works, and I'm thinking about how I want to capture the profit mechanism, the Greeks are what tell me what makes the most sense. Like I said, in the scenario here, none of these are optimal. I know that because I know the Greeks. So the way that I use the Greeks in any strategy is using it as an input against what my expectation is, and then what actual position best reflects that. So again, using SATS, because we were just on, let's use Palantir because we're on Palantir. Do I want to sell puts in Palantir? Obviously not. It's a longer term idea. Okay. So I know that this is something that I want to play the long-term drift in. So then what do the Greeks help me nail down? Well, I could play the shorter term time ranges and still maintain perpetual exposure. So what I could do is buy options that are 60 days out, and then as it comes further in time, roll those 60 days out, maintain a consistent 60-day exposure. I could do that. That's an idea. But that has implications. I'm going to have more cycles, and I could be moving this at a period where it's suboptimal based on where price happens to be in this 60-day window. So then if I go further out in time to the 15 Jan 27s, if I pick some sort of strike that's super far out of the money, I can do that. One of the problems there, though, is I know gamma is pretty much non-existent this far out. So it means that if I'm building something around the idea of gamma providing most of my P&L, I'm just going to be super sad when I get a move, but then I don't make the money that I think makes sense here. Because if I go super far out in time, I know what theta does. There's going to be more theta, but there's going to be a lower theta decay as a percentage of the total premium. There can be more gross theta decay if you go super far out in time, because what ends up happening is if you're super close in time, you literally start running out of extrinsic value in the options. So if I take a look at this 5 delta, theta decay on the 5 delta here is 8 cents. Then it goes to 6 cents at the 3 delta. If we go back out here and we take a look at our theta is like 4 cents across the board. So you can see that there actually are instances where the 7-day options will have less gross theta coming out of them, but it's because theta as a percentage of premium there is massively different. Does that make sense to everybody? If not, please tell me, and then I'll literally show you. But if it does make sense to everybody, that's cool. I'm happy to keep plugging along. The reason why this is an important point is this goes directly to the heart and soul of the question of when do we use the Greeks and how? Well, we use the Greeks and literally all of them because there's no reason not to. And we use all of them to better understand what options and what combination of options makes the most sense for the idea that we have. Another great example of this is when I'm trading earnings. If I'm trading earnings, I know that the expiration that contains earnings is most important to me. So the reason why I know that is because of the way options behave. It's by understanding that those near-term options are going to have the largest impact to their volatility. Now, this one confuses people a lot because people confuse Vega with term impacts, which is worth talking about for just a second. So if we take a look at 15 Jan 27 in Palantir, just because we're here, and we look at Vega for the at the monies, the Vega is 62 cents. Okay, that's pretty high. Let's go to, this is on 4 AUG. So let's go to 15 AUG. This expiration cycle has earnings in it. Let's take a look at Vega. Vega here is 23 cents. That's kind of interesting, right? Which one of these is going to experience a larger change in volatility following earnings? Is it this expiration that has a lower Vega? Or is it the longer term expiration that has a higher Vega? The longer term expiration has a higher Vega. So that would tell us that it seems like that would move more based on vol. But we know that's not the case. And it's because of the volatility surface. It's because Black-Scholes Merton model makes simplifying assumptions, one of which is flat vol. Well, we know that there's a volatility surface. So if I plot the volatility surface for you, we can see that, funny enough, if I plot 20 June against 18 July, what do you notice? The 20 June, the purple line, is actually higher. If I do 18 July against 15 AUG, let me do the next primary, to SEP, well, we can see that on the put side, it's higher, but then on the call side, it inverts. So there's a relationship in the surface relative to time. If I do 19 SEP to 17 AUG, we can see 19 SEP tends to be higher. This is the normal relationship where near-term options actually often will have higher vol. So even though further out in time options can have more Vega, they very frequently will experience less of a total volatility impact because volatility doesn't hit the end of the expiration cycle as heavy as the front as of the expiration cycle. This is also why when you're trading stuff like volatility, you have to be really, really careful, because somebody might say, okay, I'm going to go into VIX. And let's say when the VIX was down here in the 15 handle, or even down here, even better, it's in the 13 handle. We know at some point VIX is going to go up. We know at some point it will go up. So then we say to ourselves, okay, great. I know it's going to go up at some point, but I don't really know when. So I'm going to go far out in time. I'm going to go to the 21 Jan 26, 221 days, because I think at some point over the next 221 days, vol will be higher. Well, what's the problem? The problem is if vol is higher, let's say here, right? So let's say we got in the beginning of December, a couple days go by, a couple weeks, I should say. And then mid-December, we get this peak in vol. That's great. We're sitting there saying like, oh shit, our position should be crushing it right now. Well, what's the problem? VIX is 30-day vol. So yes, 30-day vol has absolutely gone up. But your options that are out 221 days aren't tied to 30-day vol. They're tied to vol that's 221 days out. So even though 30-day vol moved, your options might not actually move that much. And it's for the same exact reason. Okay. So we have a few minutes left. We have a couple questions in the chat. So if you had a question that I missed, please throw it back in so I can take a look at it before we wrap up. I hope the session's useful for you guys. The goal behind doing this is to do my absolute best to put you onto what ultimately matters to us as traders and what matters much less. And unequivocally, what matters much less is what the individual structure used or the individual strategy used. Those are minute details, again, that do matter a lot, but they only matter a lot once the first pieces are in place. The first pieces being things like understanding profit mechanisms. If you understand profit mechanisms more deeply and then options more deeply, the rest of this realistically becomes pretty damn simple. But that's where most of the work is done. Joe says, I had a strangle on in crude that got stopped out at 2 times max loss. Should I put on a new one, or is undefined risk a bad idea? That's up to you. You're still defining the risk at 2 times max loss. So I wouldn't say that it's inherently a bad idea, but what would be a bad idea is to put the trade on unless you have some sort of directional idea, right? So like if the idea is crude oil is going to oscillate sideways here, that's an idea. You can have that idea. But again, the context that makes that a good idea is based on what you are trying to accomplish and what the profit mechanism is. Because for me, this actually starts to look really extended to the upside with downside pressure. So for me, I would be more prone to trade something like this directionally, but that's my approach, right? Your idea might be this thing is in the low 70 handle, and you think it's going to exist in the low 70 handle for whatever duration you choose to run your strangle for. So in that scenario, the strangle can make completely fine sense. It's all based on your idea, I would say. Reese says, in the example of T, you said none of those were optimal. Is there one that was, or just that the best one captures the profit mechanism? Yeah, it's the latter of those. So what I can tell you is based on that kind of thing, lower delta at bigger size is going to make more money. And it's going to have way more efficiency in the production of that money. So, and again, this is because we're cherry picking. We looked at a scenario where we knew something moved at least 10%. Now, you can't go too far out of the money, because if you go too far out of the money, then your options can actually expire out of the money. Well, that's not good. So there is a too far, but there's a point that becomes optimal because of the compounding effect. So in T, let's just take a look at an actual scenario. So we'll go back to 27 Jan. And then we know it hits the 27 handle on 7 March. We'll do this spot here instead. We'll do this spot. We'll do the 3rd of March. So let's go to 27 Jan to the 3rd of March. 27 Jan. And let's let that bad boy load. And then in the meantime, I need to copy this over. Give me 1 sec. Okay, so this looks like it's at least copying over the base components, which is what we're looking for. So we'll use this log just because it'll be a little bit better. So the day that we're using here is 27 Jan. Ticker is T. Not ticker, just T. And then I'm going to squish this thing down so that we can move it. Stock price 24. Now what I'm going to do is size these comparatively, but I'll do it after the fact. So we'll start with our single lot. And then we know, again, this is cherry picking. So we know the 3rd of March is where it peaks. So we're going to trade around 3rd of March. So here's the first thing. I can tell you that all of these Feb are suboptimal. The reason why all the Febs are suboptimal is because you're not maximizing the move. We know, again, historic is looking at 3rd March. So something that's close to 3 March is where you're going to get the most for your move. So that puts us in 7 March. Okay. So now we know that it's going to land around 27. So then let's literally look at a few different deltas. I'm going to show you a 75 delta, a 50 delta, a 25 delta, and then what's the 27 handle at? A 20 delta. And then I'll show you further out as well. Let's do like a 15 delta or a 10 delta, which it doesn't look like it has one. So we'll just do the 22 delta. That's as far out as we can go. Oh no, the deltas are all fucked up. I was wondering why this is so weird. So we'll do 25 delta, we'll do the 20 delta, and then we'll do this one. What is this at? Probability is at 16%. There's no way. This is just because of the expiration and stuff. Let's see if this one has better deltas for us to go off of. Yeah, okay. So the 30 delta is like 0.0 and change. So we'll call the 30 delta here, or I'm sorry, the 30 strike, we'll just call this like 0.02. So super, super low. So this will be 30. The 20 delta is way up here, actually. So this will be 25.5. The 25.5 is a 13 delta, 0.13. Then the next closest we have is the 25 strike, which is a 29 delta. Closest we have to a 50 delta is here, 24. This is a 57 delta. And then let's go to the 75 delta here, 23. And this is a 0.8 delta. So let's add our cost for all of these really fast. 23. Again, I'm just going to hit them all at the offer. So 1.39. $1.39, the 24.65, the 25.25, the 25.5.14, the 30. There's no way. So I would put that maybe like 3 cents. I'm just guessing, but there's no way that it's $1.40. So I don't want to mess up the example that much. Okay. So we have all of our long calls. So the next thing we need to do, wait, where's my fucking, what the fuck just happened? This is not right. What did I do? I don't know what that is. Okay. It just copied in weird. So now let's go to 3 March. And I'm just going to pause it at wherever we're at. We'll take a look at the expiration. We'll see where everything sits. Reese says gamma factor into your strike selection. Not in this example. This is more just a showing you, but the gamma is obviously going to be wrapped into the delta, right? So like we know this at the money has the most gamma. As you go further in or out, less gamma, that whole thing. All right. So let's see what happens here. So this is at 27.72. So this is the stock up 15 and a half points. And today is now 3 March in the hypothetical. And let's take a look at what these are trading for now. Let's take a look at the 23. You get 480. The 24, you're at 380. 25, 279. The 25.5, 242. The 30, a penny. So now let's actually size these appropriately. So I'm just going to size them all off of this largest one. So $1.39. So all I'm going to do is take this divided by 4, divided by this, and then we just have to round down. So this one you get a 2 lot. Five lot, 9 lot. $46 lot. So if we take a look at the P&L for all of these, you'll notice a super clear trend. A super clear trend. The trend that you see is that the lower delta you get, that puts you in the money at expiration, if you're sizing everything the same, is optimal. So in this case, what ultimately ends up becoming optimal is the 27 strike, whatever that was. I didn't bother picking it because it doesn't matter. You can see it from here. Like this still is very much the case. Now I realized I did all of this wrong. So we'll have to double check really fast what these end up being. Oh no, I think yeah, okay, so it's still doing it correctly. I have it doing like the absolute value. Yeah. So this one would have lost money though. Anyways, the broader point is that breakdown in the delta selection for this very cherry-picked idea. And again, the way that you get to this is by having a deep understanding of options. If you understand options deeply, like this is as clear as day what works best here. Not like a hypothetical at all. And the beautiful part about that is that level of understanding of options is literally accessible to everybody. But too many traders get too wrapped into trying to figure out what strategy, what structure is the best. And as I mentioned before, like genuinely, that's attempting to answer the wrong question. If you focus on answering the right question, you will make so much more money, which is getting much, much better detail and depth with respect to profit mechanisms. Way better question. Way better question. Way more worth your time. Cool. Any other questions that you guys have? Anything else that you want to hit before we wrap this bad Larry up? And then if not, I need your help with two things. The first thing I need your help with is letting me know if you have a preference for the next upcoming skill development segment on Wednesday. And then also for the beginner stream next Friday. I need your help with both of those. The other thing that I need your guys' help with is I have my feedback forms going around right now. I'm building the one for the general outlier trading community. I did the pro one first, but I'm going to have the other feedback form coming out, and that'll be available on the Discord. It just helps me figure out where to spend time, what's most useful to you guys. So if you have a few minutes, please fill that out. It's really for your own benefit because it'll make it easier for me to prioritize for you. So awesome hanging out. Tomorrow we will have our meme stock watch. Sunday we have our trading prep. And then for those that are in the Outlier Pro Plus program, and then also like all the coaching folks, we have our first workshop slated for 29 June at 1500 Pacific time. So that will be a live Zoom call with me and whoever else is able to make it. And then we'll work through like a bunch of case studies I have in mind, some goal setting and stuff like that. So looking forward to an awesome session with you guys for that. In the meantime, if you guys need anything, as always, let your boy know. Be an outlier. See you guys later.